Both of you have extensive experience in trading oil. Could you tell us a little bit of the history of the oil price? Especially, could you tell us the three things triggered the most vigorous fluctuation in the history of the oil price?
Yeah, well, the first big increase in oil prices came in 1973 at the time of the Yom Kippur War, and OPEC nations in the Middle East and some of their other comrades imposed oil embargo on the United States and Europe, caused the oil price to ratchet up sharply, threw the world into a recession. That was the first one. The second one really occurred in 1979, 1980, and it coincided with the Iran hostage situation in which the revolutionary government of Iran had overthrown the Shah, taken U.S. hostages. And again, it led to curtailment of oil supplies from OPEC in the Middle East to Europe and the United States and Japan, and sanctions against Iran, and the quadrupling of oil prices. And then the third and most interesting and most important ones really began in 2003, and it began almost simultaneously with the U.S. invasion of Iraq. Oil prices rose for a couple years there, and then they accelerated around 2005, 2006, 2007 into a peak in 2008. And that reflected a combination of the political consequences of attacking Iraq, but also more importantly, it reflected a massive inflow of institutional hot money into the oil market as well as other commodities that hadn't really occurred in the previous two things, because that kind of institutional pool of hundreds of billions of dollars didn't really exist.
What are the most important factors that affect the oil price movement?
Well, one of the main factors people are looking at the oil market right now is the lack of supply side disruption or shortage, for the better word of it. Despite the declining oil prices, there are producers who are selling their output at $45 per barrel. You did see the U.S. fracking industry taking a hit from lower oil prices, but in the meantime, you never hear of any cutbacks from the OPEC countries. You still notice these elevated production numbers out of these producers based in the OPEC countries, and people expect that the supply increases to continue within the near term at least.
Mm-hmm. On the demand side, there are also major changes with the sharp increase in oil prices after 2003, and the fact that oil prices are still high by pre-2003 standards. What you've seen are cutbacks in per unit requirements. You've seen a lot of technological changes, the advent of LED lighting, for example, and other changes that have reduced the amount of energy needed to undertake any number of events. You've seen a big increase in the fuel economy standards in the United States and really in other countries, mandated in the United States and just sort of following the higher prices. So you've also seen a demand reduction. Even if you're still seeing more oil being used, on a per unit and a per capita basis, you're seeing a demand reduction due to the higher prices. And that's dovetailing with the supply increases that Mu was talking about to cause the current situation.
OPEC is a big player in the oil market. How important is OPEC's decision, and how should investors use the information around OPEC in trading their oil?
OPEC is a very important part of the market. It has lost some of its market power over the last 10 years due to the fracking and growth in non-OPEC production in the United States and a few other countries. But it still remains an extremely potent force. And I think what investors have to do is they have to watch what OPEC is doing, and they also have to be cognizant of the fact that OPEC is an organization of oil-producing, exporting countries. And there are massive divisions within OPEC. Saudi Arabia is the dominant member. It really sets the tone, and everybody else pretty much has to follow. And Saudi Arabia does not necessarily get along with Iran. It doesn't necessarily like what's going on in Iraq, and it doesn't necessarily like Venezuela. So the fact that Saudi Arabia has said to OPEC, we will keep our production high, is very important, because they're looking at the fact that they're very profitable even at $30, $40, $50 a barrel, whereas countries like Venezuela and Iran and Russia which is not a member of OPEC, but is an adversary these days with the U.S. government at least, have much higher costs. So, prices around $50, $45 today hurt those countries more than they hurt Saudi Arabia and other members.
We always put the oil price together with the gold price and the US dollar. What exactly the correlation among these three factors?
Well, the correlation between gold and oil has and the dollar has shifted over the past couple of years, and the gold oil ratio has been historically around 1250 to 1950 from around the early 2010 to the middle of 2014. But that ratio has spiked up in light of the decrease in oil prices to around 25. I think we were back down to around 20 because of the recent softness in gold prices. But in terms of correlation with the dollar, I think gold prices have fallen pretty sharply since 2012, well ahead of the appreciation of the dollar that was observed since middle of 2014. So and because people have largely priced in their expected increase in the Federal Reserve interest rate, the dollar gold correlation may not have been as strong as people have thought in the near term. And in terms of oil, because a lot of the price actions happened in late last year, there's actually a pretty strong correlation between the dollar and oil since late 2014, early 2015. So that suggests people have been pricing in the strength of the dollar in the oil market.
It makes sense that there's a relationship among gold, oil, and the dollar. I mean, when oil prices rise, oil exporting countries, which often have a proclivity to invest in gold, have more money. A lot of the money that's coming in, almost all of it, is in US dollars. So there's a petrodollar sterilization program where they're buying gold that tends to drive the price up. Also, when oil prices rise, it tends to increase inflation in developed economies, and it also tends to reduce the stock market returns, so that you tend to see people interested in gold in developed countries. Now, with the dollar, it's changed a little bit because the United States has gone from being a net importer of oil to being basically self-sufficient on an energy basis. So the negative consequences of higher oil prices on the dollar are gone. And conversely, on the downside, when the oil prices fall, it's much more beneficial for Europe and Japan than it is for the United States now.
So in your opinion, what kind of economic indicators should investors pay attention to in order to trade better?
Well, there's not a singular set of economic indicators that investors should watch. As we would suggest to all of our institutional clients who invest in the oil market and other commodity markets, you should always take a careful look at all the indicators in the market. It could be GDP numbers and PMI, industrial production, consumer confidence. So all of these indicators, mixed as they seem, paint a more or less more comprehensive picture of where the market we're standing right now. And also, people should not be looking at oil prices alone. They need to look at how the stock market is doing, where gold prices are, and where the copper prices are. Oil is the oil prices is. It gets its input from all of these macro factors, and there are also metrics within the oil market that people should watch out for. The inventory numbers, for example, and there are people who are watching the barges of oil sailing in and out of delivery points in various parts of the world, and that forms a picture of where the physical oil is moving. I think that's also an interesting thing to watch. In a nutshell, there's not a singular set of indicators to look at, but I think what's the most important thing is to watch what market reactions to these indicators, and that helps investors form their decisions about how to trade oil.
Yeah, oil is a lot like gold in that it's a really complex market, and a lot of things affect it. A lot of macroeconomics, a lot of different macroeconomic factors all have an effect on the price of gold, on oil. as do monetary policies in the United States, Europe, Japan, China. But in addition to that, the fundamentals. And if you look at our research, you know, our price forecasts extend from 1 week to 10 years across all of the commodities we follow. And all of those forecasts are developed by blending a macroeconomic top-down analysis of what's going on in the broader world and a microeconomic fundamental view of what's going on with supply and demand and short-term conditions, for example, shipments and stocks and inventories.
What kind of risks does trading oil involve, and how should we manage them?
Well, there are, again, tremendous risks, and one of the primary risks that you have has to do with the fact that so many factors can affect oil, including not only the fundamentals and the economics that we talked about earlier, but also political developments. So when you're trading oil, you have to look at those factors. You also have to be cognizant of the fact that there are a lot of short-term traders who will trade ratios like the gold oil ratio or the gold dollar ratio, and they'll look at mathematic formulas. And so you have to pay attention to that. We're big advocates of hedging one's positions, whether you're a user, a producer, or an investor. And I think that that's really important.
And I think Jeff has covered that very well. I'll just add that I think the two market metrics that I think is relatively important in the near term are the volatility as well as the volumes of trading in the oil market. Oil has been historically a very volatile market, and that volatility has surged in 2014, has come down in the early part of this year, and as oil settled into those relatively narrow trading ranges. But you know, any macro or fundamental or technical factors can drive up volatility again, and so that's one of the key metrics investors need to watch out for. The other metric is the volume of oil trading, whether there's, and I think it's key to understand the relationship between price changes and the volume trading and the oil market in any given time frame. And if a solid understanding of these two factors can be achieved, I think people can have a better view of where their risks are and the opportunities out there.
How can investors determine the bottom of the oil price and their long-term goal?
Right. At the end of the day, commodity prices, like other asset prices, stock markets, currencies, housing, are really not knowable. And you can do as much research as you wish to try to build fences around the unknowables and learn as much as you can. When we look at the oil price today, we look at the fundamentals of supply and demand, what it costs to produce oil, what trends are going on in consumption. And our view is that we're probably pretty close to the bottom on a cyclical basis. You know, prices trading around $45 a barrel, West Texas, as we speak today. It could go a little bit lower, but we think that you're probably bouncing along the bottom as we have been for some time. We don't necessarily expect the price to rise sharply in the near term, but we don't necessarily expect it to fall further. So we're looking at a range over the next year or two that might be $44, $45 on the bottom where we are today, but maybe $65, $70 on the high end. Longer term, we tend to think the oil price will go higher. However, we have to say that the energy complex is up for complete redefinition in a way that it hasn't been up for redefinition since that 1973 oil embargo. And you've got a situation with increasing nuclear power, increased attention on nuclear power, solar, wind. You have energy consuming technologies changing. You have a lot of political factors that are both short-term and long-term. And the whole energy complex is probably up for redefinition, which is probably going to make oil prices a lot more volatile than people would expect they would be otherwise.
Well, I think there is going to be a longer-term supply response to relatively low oil prices. At the point we already are seeing producers cutting their exploratory and reserve development expenses, and that could have a repercussion in the oil market in the longer run, and that the cost inflation rising out of the slower reserves replenishment of the producers, that could to some extent provide a level of price support. And the other factor to watch out for would be how investors respond to lower prices, and there is a level of interest among some of the longer term investors right now, and that oil prices are so low, whereas in the longer term, if you look at China or India, the major consumers are there. So there still are a great potential for oil prices to rise higher.